Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
And we're back. Like the man said, you can call us 216-901-0945, 216-901-0945. Feel free to give us a call. Have any questions regarding investing or personal finance? And I'm going to dedicate today's show primarily to some planning and investment planning. Regular financial planning, retirement planning, and investment planning are not really the same thing. They're very closely related, but they're not identical. There's some differences there. We'll talk a little bit about both. The latter part of today's show, the last 15 minutes, I'm going to go through individual stocks to kind of give you an idea of how I think with a portion of the money I run. Now, a lot of people get confused when they hear me talk about that. That's why I'm going to talk about it only at the last section of today's program. So right around 11:45, we'll start to talk about the individual stocks because I don't really want to. I want to keep that a little bit separate because people are getting confused. So in the meantime, I had an intern who came and worked a couple of his breaks between semesters, and actually before he went to college, and then he came back, worked a break in a semester. He was going to college on a baseball scholarship, and he's a pitcher. And he's about, probably somewhere around 6'4", 6'5" now. It's amazing. He kept growing all the way through college. And he's a left-hander, and he throws a wicked sinker and throws in the 90s, was one of the very few people in the Northeast Ohio area in high school to throw a perfect game for St. Ignatius. So he threw a perfect game in high school. And this year he was just drafted by the San Diego Padres. So he's in their farm team now. And he's finishing college. It's really amazing because he was drafted before he graduated. So he's still finishing college. And anyway, I would give you his name, but I didn't get his permission, so I hate to do that to somebody and call him out like that. But maybe we can get him to call in on the show one of these days. I know he's listening. He listens to the podcast, by the way. I don't know if you knew this or not, but this is simulcast on YouTube. There's no video. It's just the sound. And it's simulcast. You can actually, not simulcast, but it's stored, so you can download this on Apple iTunes. And there are a couple of other podcast sites that you can go to and get the Bullington Capital Report. So if you just want to Google that, the Bullington Capital Report, you can go and find those on those areas. And I know a lot of people are doing that, and so but I would just help you out and mention that as well. Anyway, so kind of pertaining to what I started talking about earlier on the show, we're going to separate the show into segments. This segment, I'm going to talk a little bit about retirement planning, getting ready for retirement. It's a big deal. And Nick, part of that's funny. Well, I didn't use his last name, so. Anyway, my intern writes and says, hope all is well. He's been listening to the radio shows. He's out in Arizona right now. And he's got some questions for me. He's doing some research on a paper to finish up his undergrad degree. And his major's, I think it's finance. I know it's either his major or his minor. But anyway, one of his professors asked him to do this. And so he had some questions for me. How much money do people think they need to save for retirement? How much do they actually need? That's a really good question. What are the kinds of plans people have for how they're going to pay for things in retirement? Social Security, pensions, and will that give them enough? What do you think most people know but need to know about saving for retirement? And is there a lack of information available to people, or do people just not want to think about that far ahead? And if there's anything else you think is really important, include about retirement. Yes. That's pretty funny and pretty interesting. And it's very encouraging that he's looking at these issues and that they're teaching this in college, because I can tell you when I was going to school, they didn't talk about this at all. It wasn't talked about in any of the classes. There was no degree in financial planning back when I was in college. It was actually a certification you got from a couple of industry associations. Anyway, so here's what I did. I wrote back, and he's probably going to be sorry because I almost wrote a book. It's got to be a couple thousand words. Anyway, here's the answer to the question about how much do people need to save for retirement. And what you need, incidentally, if you have grandkids, you should probably start talking to them when they're like 10, 11, 12, because they know enough math to understand what you're saying, at least most of what you're saying. And if you wait until they're teenagers and their hormones kick in, you're not going to be able to talk to them again until they're in their mid-30s. So you got to get them early, got to get them young, and they can understand this. But the answer is you need somewhere between 20 and 25 times the amount of money that you want to spend in retirement. Between 20 to 25. Now, I've heard people say, oh, you only need 8 times. Really? What are you going to do in year number 9? If you live too long, that can be a big problem. If you saved 20 times and you spent 5% of the money, 5% is the same thing as 1/20th. So if you didn't make any money, you'd still run out of money in 20 years. But somebody in, retirement age probably has about a 20-year life expectancy. If you earned more than 5% a year, you'd actually have more money than you started with. But if you do like an average investor, and by the way, over that 20-year time period, you're going to have inflation, so you're going to want to increase that at some point in time. That's why I say 20 times, and you need to make some money because you're probably going to have to increase that over time. So let's do a little math. If you wanted to take out $50,000 before taxes, you'd only need $1 million. Don't you feel better? $50,000 a year, you only need $1 million at 5%. Now show me a 5% CD, by the way. And if I had real CDs that were paying 5%, that big sucking sound you hear would be all the money coming out of the stock market. There are tons of people that would take that 5% and run. They would just spend the interest. Unfortunately, 5% interest rates are not available today on anything that's super safe. You can get 5%, but it's only as good as the guarantee of the company that's making that guarantee. Anyway, so you need $1 million to be able to do that. If you invested in a balanced fund, stocks, bonds, and cash, or had a balanced account, and you systematically withdrew 5% a year, you shouldn't run out of money, assuming that minimally for 20 years, assuming that returns don't go to zero or stay negative for extremely long time periods. That can happen. That can happen. We're not allowed to guarantee that won't happen, in fact. If you want to keep up with inflation on top of your withdrawals, you'll need to earn substantially more than 5% a year, or you'll have to reduce your withdrawals, maybe down to 3 or 4%, probably 3%. So, it's shocking when you start looking at that. So, long story short, you need about $1 million for every $50,000 you want to have in income if you were to retire today. That's today. Inflation is going to increase that number in the future. So as you get older, $50,000 doesn't buy as much as it did 10 years ago. And it doesn't buy nearly as much as it did 20 years ago. So if you're a long way from inflation, you're going to need about $1 million for every $50,000 that you want to take out each year. And $50,000, if you're 20 years old, $50,000 by the time you're in your 60s, it's going to be worth somewhere around $15,000 in today's dollars. So if you think it's hard getting by on $50,000 in today's dollars, wait till 40 years from now. And it's going to be a lot harder. Anyway, that's neither here nor there. You need about $1 million for every $50,000. Fortunately, Social Security's here. the average Social Security payment is around $1,400 a month. That's the average, by the way. I think the maximum is somewhere around, it's a little over $40,000. So at $1,400, you're at $16,800 a year. So if you had a Social Security payment paying $1,400 and you get $16,800 a year, that's just like having $366,000 in an investment account that you were pulling 5% out of. Now, the difference is 5%, you have to take a little bit of risk to generate that return. And in the Social Security program, it's guaranteed. But Social Security program, it stops when you die. And, if you still had assets left over in your investment portfolio, they would go to your heirs. So a lot of differences, but it relieves you, by the way, from having to save that $366,000. So, and somebody that's earning over $50,000 a year, by the time they get ready to collect Social Security, it's going to be more than $1,400 a month. So it's going to relieve an awful lot of what you have to save. So that number before you use Social Security looks, $50,000. I need $1 million. Holy cow! Well, you can take about $366,000 off of that. In fact, for you, it's probably going to be more. You probably have more, closer to $2,000 a month, which saves you about $500,000 that you have to save, which should be a pretty big relief. And I'm sure would actually lower the divorce rate if they taught this to married couples. That Social Security payment's worth a lot of money. You might want to hang in there. I'm just kidding. Yeah. Anyway, most people are not aware of these little factoids. And that is the biggest problem as far as I'm concerned. They're not aware of it. They're not teaching this. It becomes very daunting to most people. Once they're exposed to this issue, a lot of people think, oh, it's just insurmountable. I can't do it. No, you can do it. It's a lot easier if you start young. It's really a lot easier when you start young. But you just do the best you can. You can come up with some projections. I've got a tool. Anybody that, when you hear this, if you really wanted to sit down and go through this, we're going to do that for you. You can call us, set an appointment, go to my website, bullingtoncapital.com. It only takes me about 10 to 15 minutes to do this if you come prepared. Now, if you come and it always kills me when people come in the office and or they call me on the phone and I need a retirement plan. Okay, well, how much income do you make right now? I can't tell you that. Really? Well, guess what? I feel like the Alice in Wonderland. Which way should I go? Where would you like to go? I don't know. Then any road will do. But I need to know how much money you're earning now, because that gives me an idea of what kind of income we're going to have to replace. Generally, you can get by on about 80% of that pretty easily. Some people, need 110% of what they're making right now because they're spending everything they make and they go into debt. But that's an individual thing. But it's pretty easy. How much income do you have? How much in savings do you have? And how old are you? How much income? How much in savings? And how old are you? That's all you really need to know to do one of these plans. Anyway, again, the biggest problem I see is that once people start to put a little math to the numbers, they're like, whoa, and they get intimidated. And if they only knew, if they taught in college, which is very encouraging that they're teaching these kids to look at these things, if they were saving about 15% of their income in a balanced fund, in an IRA, 401k, or any other type of retirement plan, it allowed most of them to reach their goals as long as they started before they were 30. When you're past the age of 30, you have to save more. That's tough. You think saving 15% is tough, or you think living on 85% of your income is tough, wait until you're living on 20% of your income because you're too old to work and all you have is Social Security. That's tough. That's really tough. So chin up. You can do it. Just get started. Do the best you can. If you put it, why did I say put it into a balanced fund? Because professionals managing it, and in your IRAs, 401ks, or talking to a financial advisor, they're going to recommend that, and you don't have to worry about it. It's not as volatile as a pure stock fund is, but the returns have a tendency to be a little bit lower over time because they're not taking as much risk. But you should only take as much risk as you can handle, and that's a tough one. That's a tough question. How much risk can you handle? It is really difficult. We'll come back to that on a different show. Anyway, when you're putting that money in a retirement plan, it's pre-taxed, incidentally. So it's not going to cost you the full 15%. Depending on your tax bracket, it probably costs you somewhere between 10 and 12, depending on what your tax bracket is. So even though you're putting away 15%, it's not costing you 15%. So you won't be living on 85%. You'll be living on something slightly higher than that, which is good. Probably closer to 87 and 90%. Anyway, pensions. As far as pensions goes, I wrote that they're going to be a thing of the past. The pensions that companies used to have, now they're getting rid of them. They're getting rid of them, and they're going to these these other programs where they're matching your contributions, 401ks, 403bs, 457s, that kind of thing. They're matching your contributions, but you are putting in a lot of the money yourself. If you are fortunate enough to work for a government entity, the federal government, or a school system, a police and firemen, they have very good pensions. They put a ton of money into those pensions for those people, for the participants. A ton of money. That's why their salary, you hear them talking about, the salary is so low. Yeah, but they're on average, there's about 25% of that salary between the employees' contributions and the people that the entity that they work for, the two combined, they're saving nearly 25%. Think about that. I'm saying just save 15. They're doing 25. That's why they have really good pensions, by the way. And they don't give them a choice. You're working there, you're a participant. And that's probably what they should do. And I think it's a great idea. And this is one of the things I pointed out to him because the next point I want to make is the cost of saving. The cost of saving money in a tax-deferred plan like a 401k, 403b. I hear people talking about this all the time. It drives me nuts. They don't have any idea how much they can save. And I'm going to tell you how you can save up to 64% on the cost of saving money right after these messages. You listen to Bill Bullington right here on 1420. Stay tuned. And we are back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon. If you missed this show and you still want to hear it, you can always go to my website. It's available there. It's also available on iTunes. And I think it's available. I'm not sure if you can download it. 955thefish.com as well. You can go back and it's saved as a podcast there. So we're just kind of talking about the things that people can do. I had a question sent to me, actually multiple questions from a former intern getting his college degree. He's doing a paper on retirement planning, part of his subject matter. We're talking about pensions, and we're talking about how they're going away. A lot of private corporations are not having them anymore. A lot of the people that worked at General Motors, their pensions got cut back a little bit. And, it's just not that popular anymore. And a lot of the companies that used to have them are shutting them down, giving the balances that the participants are entitled to them to roll over. Many of them are spending them. Not a good idea. But be that as it may, that's what's happening. So if you're not working for a government agency, your pension, it may not be there at some point in time. And if it's a private pension, then and it's not a government agency, I would be saving on the side anyway. Ask anybody that's worked for an airline or LTV Steel what can happen to their pension. Those are promises that are made by the companies, not a government. So you got to watch that. That can be very dangerous to rely exclusively on that. Anyway, so here's one of the biggest advantages to the other types of programs and types where they let you take money out of your check before you pay taxes on it. 401ks, IRAs, you're allowed to deduct from your taxes. 403bs, 457s, a bunch of different deferred comp. There's a bunch of different names for these programs. They all work very similarly. And here was an example that I chose, and I never hear anybody talk about this, which is why I want to shed a little bit of light on it, because it's a huge benefit. It costs you 64% less to save money in an account that's pre-tax on average. Now, that's somebody who is in a 20% marginal bracket. Somebody's in a 20% marginal bracket. And here's the example I used. So if I'm going to save $100 after taxes, and I'm paying 20% in federal taxes, I'm going to have to take $125. I'm going to take $125 of my pay. I'm going to pay $25 in taxes, because that's roughly 20% of 125, to be left over with $100 to be able to invest in my account. So earn $125, pay $25 in taxes, and I'm going to take the $100 and invest it. Okay, now, if I took that same $100 that I have, but I took it out of my check pre-tax, and I'm in the 20% bracket, it only cost me $80. Okay, because I saved the $20 in taxes that I would have paid. When you figure the difference between 125 is what it would normally cost to 100, well, that's a 20% savings. But if you go from 125% down to $80, that's $45 that you saved that you did not have to pay in taxes, and that ends up to being 64%. So you got $100, and instead of costing you $125 having to pay $25 in taxes, you put $100 in your account, and it only costs you $80. That's a 64% drop. There's no place in that is the closest thing to magic you are ever going to see. Only cost me $80, and I got $100. And if I'd have paid taxes, I'd have had to pay taxes on $125 to be left over with that. Saves you an enormous amount. So the cost of saving in a retirement plan cannot be beat. That return is guaranteed. That's one of the things that we can say is guaranteed. That's guaranteed. You get that day number one. So if you are not maximizing that, something is wrong with you. You don't understand basic math. You need to go back to that fifth grade school teacher and learn percentages really quickly. Now, I always get somebody who goes, well, you're going to have to pay taxes on that someday. Well, no, you're not. No, you're not. You're going to spend a little bit of money each year, a small percentage. Remember I said 5% at the beginning of the program? There's a pretty good chance that if you do this right, that you will never spend the original contributions that you made, that you'll have that much at least left over when you pass through this world. There's a really good chance of that, but you've got to follow certain guidelines. Invest in a balanced fund and keep investing. Do it until it hurts. You don't even actually have to. For a lot of people, can't do it until it hurts. Yeah, and I feel bad for the people. I got a nephew that can't contribute much at all because with a 401k plan, it's governed by how much everybody in the plan is investing. So if a lot of people in your company are not putting money into the plan, the people that want to put money into their plan can't. There's a top-heavy investing whole series of guidelines, rules that say, yep, yeah, well, we'd like to be able to help you out, but nobody in your company is contributing this, so you can't either. And that's a little nuts. They need to change that law. But anyway, so when somebody tells you, yeah, but you're going to pay taxes on that one day, guess what? The fact that you avoided, or the cost, when you add, where is there a 64% tax bracket? That's what I want to know. I haven't seen that anywhere, maybe outside of America. But when the savings is 64%, We got a pretty big edge on the tax man. And by the way, it grows tax deferred over your entire lifetime. How's that? You just can't beat these things. You can't beat them. And people are not talking about that. That's a problem. That's a big problem. What I just said, you should go back and play that over and over and over. You should cut that little snippet. Maybe I'll try to do that on the internet. Cut that little snippet out and send that to every kid, every 12-year-old that you know. 12-year-olds know what 64% is. They know that's a big discount. And I'm telling you, this is the closest thing to magic that you can possibly imagine. And I'm just amazed that somebody thought that up. And, maybe I should be quiet about this. If Congress hears about this, they'll probably change those rules. Lickety split. But I hope they don't. And I've heard some really crazy things. Oh, you don't want to save so much in a 401k because they're going to come and confiscate it one day. Really? Do you know how hard that is? Do you know how dangerous that would be? That would be incredibly not a good thing to do. They would not do. They don't need to do that, by the way. They do not need to come and abscond with your money to get their hands on it. All they have to do is raise the taxes a little bit. All they have to do is delay the Social Security age a little bit. All they have to do is base the average increases on something other than the real inflation rate, which they've been doing anyway. And they're fine. They're gold. Nobody's ever going to come and take your 401k money. They're not going to confiscate it. I keep hearing, well, taxes are going to go up. Well, they're not talking about that right now. And if you know exactly what they're going to do, I'd really love to borrow your crystal ball for a minute because I have some questions I'd like to ask about the stock market. I should probably not take that tone away. So I apologize. But it's just kind of funny. And these are one of the greatest inventions ever in the history of mankind. It is. Even if you just say, all right, I saved $20 in taxes, don't forget the point that you would have actually had to made $125, paid $25 to be left over with $100. Even if you got that part. The fact that you saved $100 and it only cost you $80, if you were to tell people that, you'd probably, if you held up a sign in the middle of a Walmart that says, "Hey, I'm going to give you $100 towards your retirement, and you only have to pay $80," you would get trampled. Especially if we went there on what is that, Black Friday? You're going to get run over. Yeah, but that's available to most people. And if you don't have that through your employer, you have an IRA. So that's what I think is one of the things that is not really emphasized. I'm the only one I know that uses this as an example. And I know, there are a bunch of tax guys out there that want to take issue with it. You can't. The truth doesn't need defending. It stands on its own merits. Are you going to have to pay taxes on it one day? Yeah, I hope I'm so rich that they have to create new tax brackets for me. Probably ain't going to happen. But especially since Warren Buffett's it ain't happening to him. But I hope I have a massive amount of money. That's another thing that I hear a lot. Oh, you don't want to save that much. It's just going to mean more taxes one day. Well, yeah, see, when you make more money, you have to pay more in taxes. That's the way it works. So I'd really like to make the money. I'd really like to have that money. It's not going to be worth as much. Just look at the tax deferral alone. They have calculators all over the internet. You can look at the growth of a tax-deferred account versus a taxable account. And unless you're getting ready to spend the money in 4 or 5 years, in most cases, the tax-deferred account, not the tax-deductible tax-deferred, I'm just talking about the tax deferral, is such a strong thing. So I'm pretty sure if Congress understood these things, they probably never would have given them to us to begin with. So that's a good thing. And but anyway, that's what you should pay attention to. It's a lot easier to save. It also comes out automatically. That's a big, big plus. And it comes out automatically. And so these are all the things. And I think I have a couple thousand words. I skipped a lot of the words on the show, by the way. I feel bad for this kid having to read this email. But anyway, waiting too late has severe consequences, incidentally. This is something that you need to start talking to kids. And I think about right around the time they're 12. I think really right around the time they're 12 years old. Because when I was 12, I had a paper out. and I delivered to this apartment complex, and the people in that apartment complex were notorious for not paying their bills. They'd see me come collecting. They just wouldn't answer the door, and they would move after owing me for 4 or 5 weeks. And that would happen over and over and over again. I was 12. So it gave me kind of a perspective on some people. Not that nice. But anyway, I did realize I had to pay for those papers, and I had to pay for them out of the profits that I was making on people who paid their bills. And so I wasn't making very much money. And I think that was actually a great experience. I think it was a great experience. I ran a little business there. I was an independent contractor, and it was cool. Now, I wish I would have had houses instead of apartment buildings, because houses, they can't get up and move. But it was still a really good experience. And I know I knew enough that I could have understood what I'm saying here today at that age. I know I could have. And that's what you should really do is put a course together for 12-year-olds. It's about the time Warren Buffett started delivering papers. I read his book, the authorized biography. Anyway, what was I? I'm trying to think now if I said anything else I would talk about. But after the next commercial break, incidentally, we will talk about individual stocks. I've gotten a few requests for that, so I'm going to lay that out for you and tell you what I'm doing. Tell you how strong the market is right now. It's pretty strong, despite the fact, it's amazing when market goes down just a little bit, and people are, see, I knew it was going to go. Well, you know what? That's kind of normal. In fact, I think I saw at one point in time that the number of up days versus the number of down days, it was something like 52% versus 48%. And think about that for a second. I know most people think the market goes up a large percentage of the time and only goes down a small percentage of the time. That's not true. It goes down a lot. It just goes up more occasionally than it goes down. And it's the old 2-step forward, 1-step back routine. I think that's probably somebody that was watching financial markets that came up with that saying. But in the long run, it works very well. And we will talk about a lot of that stuff. If you have any questions, if there's anything that you'd like to see, if there's anything that you'd like me to talk about on a radio show, feel free to email me or give me a call. No big deal. Either way. And I really enjoy getting the questions. And I feel bad for people that they don't have access to really good information out there. And they do have access to it, but it's buried. I mean, there are millions of pages, billions, probably even trillions of pages on the internet. Financial topics are one of the biggest topics, as they probably should be. But there's an awful lot of that information that's not that helpful. And I think it pays to know which information is helpful versus that stuff that you really don't have to pay attention to. But anyway, so if you have any calls, questions, comments, feel free to send them in to us. You can call here, 216-901-0945. If you have anything you'd really like to talk about. And I got that off my chest. That's I'll be revisiting that program. It was one of the other big concerns for people that I hear about a lot is are people running out of money during retirement. And if you're planning on spending much more than 5% out of your accounts each year, that could be a problem. You are right. That's an issue that you need to probably try to deal with. Figuring out how to live on 5% of your investment accounts, your savings, is a very good thing to do. Anyway, I hear the music. That means I have to take a real quick commercial break. Hey, when I come back, we're going to talk about some individual stocks. And I'm going to give away a free Starbucks, $10 Starbucks card to somebody that can answer the question that I have for you. This is Bill Bullington. I'm right here on 1420 The Answer. Stay tuned because I'll be right back. On a magic carpet ride, you don't know. And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon. And you can also reach me by going to my website. You can actually pick up this show by going to the website. It's bullingtoncapital.com. You can download it. I would probably, if you like individual stocks, I'd fast forward to the last 15 minutes because that's what we're going to be talking about today. I'm also going to give away a Starbucks gift card. This is going to really test people. It's only $10, so not a big deal. But if you know the answer, call us 216-901-0945. And here's the question. There was a solar panel manufacturer that merged with Tesla. Who were they? It used to be they were trading independently, and I think their symbol was SCTY. But who was the company that merged with Tesla recently? And it was a solar panel manufacturer. So the number is 216-901-0945, 216-901-0945. And that is such a tough question. I'm sure I probably won't get too many answers on it, but here's the call now. What was the solar panel company that merged with Tesla? And I can give you a small hint, too. They were his cousins. They're cousins of Elon Musk that actually merged. He merged and took them into Tesla. So having said that, got a couple phones ringing and see if anybody gets that. It'd be interesting. 216-901-0945. So I'm going down, and I manage a little bit of money using the technique that I'm going to talk about in over the next few minutes. And I kind of hesitate to talk about it because a lot of people get it confused. They think that this is all I do. And this is a very, very, very small portion of what I do. And it's not something that you should take lightly. It's something that you really have to work at if you're going to do a good job of managing money this way. But it's basically following trends in stocks. I like to look at companies that are going up really fast for this particular strategy. I like to trade or buy them when they're going up, which is, that's a good thing, right? That's what we're trying to do. And if the trend breaks down, I want to get right back out of it. So defining the trend is kind of key. And here's how I define the trend. Stock has to be up 3% or more in a day, in one day. On any given day, you won't really find all that many stocks that are up 3% on the day. There'll be a couple hundred of them, but it's not nearly as many as there might be. The other thing I like to see is that over the past 1 month, 3 month, or 6 month time period, those stocks are in the top 20% for overall performance. So in other words, the stocks are in a good, strong uptrend. They're leaders over a 1 month, a 3 month, or a 6 month time period. Any one of those time periods, if it's in the top 80%, the top 20%, I mean better than 80%, I want to know about it. So it's up 3% today, and it's in the top 20% over 1, 3, 6 month time period. What am I looking for? I'm looking for strong stocks that are still strong, that are staying strong. What do I mean by strong? I mean it's going up fast. A 3% increase in one day is pretty fast. That's actually incredibly fast. Okay, the fact that it's already been moving is very helpful. And when you look at these screens, I'm looking at it right now. There were 55 stocks that made that criteria. Oh, by the way, I also require that the company has to have more than $250 million market value. Why? Because that's about as low as a mutual fund will go. Below 250, they're considered a micro cap. Can you imagine that? $250 million considered too small for a mutual. That blows my mind. That literally blows my mind. So you've got all these criteria. It's basically $250 million or better. It's in the top of all performers of all those stocks in the United States over some period, whether it's 30 days, 90 days, or 120 days. That's 1, 3, and 6 months. And it's up 3% again today. And that's where I start. And then I start digging down. And I start looking at them. Now, by the way, you will not be able to invest in all those companies. There were 55 of them that came up yesterday. Yesterday was not particularly strong. So there are days when I'm going to have to look at a couple hundred stocks. So you've got to have a way of figuring out how to choose which ones you want to buy, when you get that list down to just 55. Now, I'm generally going through there are some patterns that I like to look for. And if those patterns are not present, I'd rather pass and go on to something else. So that's something that I'll talk about at the next seminar that we do, but I haven't even scheduled that yet. So don't get too excited. Anyway, I got to take a phone call really quickly here. I've got, it says Chris.
Hey, Bill.
Hey, how are you?
Hello.
Hello.
Oh, good. Yeah, can you hear me?
I can
Hello?
now. Yep. How are you doing?
Yeah. Hey, good. Hey, two stocks. One, IBM, I've been looking at, had a great pop after earnings, and now has given up most of it.
Yeah.
And dividend now approaching 4%. Seems to have plenty of cash to always cover this dividend. And I don't know if you have any thoughts on that one or not.
Actually, I really don't. I don't follow IBM. I haven't followed it for years. And I'm just looking at the market cap. It's almost 140 billion, and the revenue is about 78 billion. It's a little over. It's close to 2 times sales, and their growth rate is flat completely.
Yep.
It's okay. Dividend yields 4%. That's not bad. It's just okay. I wouldn't say it's a screaming buy.
Okay.
Now watch it go up 40% tomorrow.
Okay. Hey, one more that I still think is a screaming buy, although I sold it and got back in after it crashed. Sina, S-I-N-A. Company making tons of money, great earnings, blew out earnings again, blew out sales, and has an asset known as Weibo that is worth $11 billion, and the company sells for $7.5 billion.
They own Weibo?
They own 46%.
Huh.
46% of Weibo.
I'm gonna have to go look at that.
They gave a dividend of a share for every Sina share you had. You got for every 10 shares you got a share of Weibo. So, but the thing is, this Weibo is worth 20. I don't remember now. I'm in the car. 21 or 22 billion. And if you take 46%, you get over $11 billion value, and Sina stock sells for $7.5 billion. Doesn't make any sense to me.
That actually happens quite a bit. What I would do with that is I would watch, because at some point in time they will do a spinoff. Based on what you're telling me, that would be one of. They're probably under a lot of pressure. Their board is to probably try to do something like that now. And
well, they had some activist one of the companies that was like the 4th largest holder of stock, tried to get them to do something because they thought the stock was worth 190.
Yeah.
And they blew it out. they blew them down.
Yeah, they didn't have enough shares to get control, because market cap being $7.5 billion on trailing 12 months revenue of 1.4, that's not super cheap. That's like 5.5 times sales. That's not super cheap.
I don't. I went through the same thing with Yahoo when I had it. Here's a company that if you break it up, is worth a ton of money. And in this case, just the value of their investment in Weibo is like $145 a share, $150 a share.
Yeah, I've seen a lot of companies do that though, but I've seen them go sideways for a decade like that. So it really depends on how much patience you have.
Well, then you got everybody's favorite Alibaba owns like the 30% of Weibo, and Sina owns 46%. You would think at some point somebody's going to say, "Let's buy it."
Yeah. That's basically the value investors' main issue. They call those value traps. You can get stuck in those things for a really long time. I know I've been a part of a lot of them. So it's that's one of the reasons that I really don't do that anymore. I stick to just the trend following thing, and the other styles that I use are other managers, because I just don't have the time anymore, and quite frankly, I don't have the patience. I don't. I hate waiting around for a year, even though I know it's there's a potential for it to turn out really big. But I've also seen a lot of situations where the regular business is deteriorated to the point that the value did come down, while we were waiting for that to happen. So that's tough. That's really tough. If it came up on a momentum scan, I would buy it. Probably put especially Cena, I'd put it on a stop loss on it, and then I would let it rip. But those are, I understand what you're saying.
Yeah. Well, WIBO was up like 10% the other day. Came down just yesterday, but it was up about 10%, $9 a share.
Yeah. Well, like I said, it's just it can be a really, really long time, and I hope it's not. If you're buying the stock, I hope it happens quickly. But
I guess I just don't understand Wall Street thinking. I just don't get it. I don't see how they see a flaming buy like this, where it's all. I mean, you're basically buying Cena for you're buying.
Oh, believe me, I've purchased stocks for less than the amount of money they had in their checking account. And then it still took a long time. Hey, I got to run though. I got to hear the music. But thanks for calling. And for the rest of you, this is Bill Bullington here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
Caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.